Hello, Elisa Ferreira, and welcome to this interview in which we'll be focusing on the single resolution mechanism, one of three key components of Europe's banking union project, which was agreed at the end of last month, but only just after marathon negotiations between Parliament and Member States. Let's take an overview and just describe what it is that it achieves for European citizens as a whole.
In fact, we are moving from a non-controlled kind of environment. What happened is that taxpayers were called in, there was no alternative. National supervisors were poor supervisors of banks that were bigger than the member states sometimes. So we had a kind of a loose environment, and we are moving to a completely new framework. In fact, there are three legs. The first one is a stronger supervisor that is detached from the contamination of being too close, too influenced. And so the ECB is the entity that after November this year will start actually supervising directly the big banks, the smaller ones through a coordination with the national supervisors, so strong supervision with teeth, with capacity, the legal basis. And imagine that a bank is seen as, okay, this bank cannot operate anymore. It has to be either insolvent, like if it was a factory, so you just close it down, or it has got to be resolved. What this means is restructured in some way that, okay, you allocate losses to the owners of the banks, and then you have a fund financed by the banks according to their risk profile that helps to safeguard or to move away healthy parts of that bank. And the third leg that is missing still is to have a common guarantee of deposits. So it's the third leg is not there, and what we have been addressed is how to resolve a bank.
What do you say to those people who say that, as they have frequently, that the resolution fund of around 55 billion euros is hopelessly insufficient for the kind of level of funding that might be needed where a big bank, where a cross-border bank to fail?
I question those estimates, because what we have as a comparison is a completely different situation. If you are going to bail out, I mean, if you are going to support the shareholders, the junior and senior bondholders, and to pay from taxpayers to cover their losses, and that's what we have done in the past. Of course, 55 billion is no way a sufficient fund. But the purpose of the fund is not to cover losses. We want, and this is the new framework, the losses will be allocated to the shareholders, to the junior bondholders, senior bondholders, so it is inside the structure of the bank.
One final thought, which is those people who say that you should have been able to do two things at once. You should have been able to put in place the mechanisms for banking union, and at the same time put in place other mechanisms for growth.
By doing banking union is necessary, it's not sufficient. We need other elements in our agenda. We need stimulus for growth. We don't have it. We don't have a budget. The budget is 1% of GDP. We need to fill the gaps of the monetary union. We don't have any engine for growth. We have a kind of a big airplane, but it doesn't have an engine.
Okay, Elisa Ferreira, thank you very much indeed.
Thank you very much.
I appreciate it.
Thank you for your interest.
Thank you.